Alright, those are the top headlines that we are tracking today. For the markets, continues to be under some pressure. So Nifty is down 34 points. Banking side, although is seeing some recovery from the lows, that index, though flat, is seeing some positive bias today. And the stock that is at the day's high is Axis Bank. So let's continue with that story only. Lata Venkatesh is in conversation with Amitabh Chaudhry, MD and CEO at Axis Bank, to discuss the impact of RBI's MPC decision and a lot more as well. Lata, it's over to you.
Thanks, Sonal. Yes, sir. Amitabh Chaudhry is with us. And Amitabh, thank you very much for joining us on our big days. You were with us when we inaugurated our spanking new studio. And thank you very much for being with us on our 23rd birthday as well.
Well, Lata, thank you so much for inviting me on this program today. Wishing you a very happy birthday and the very best to CNBC and the entire team that makes the channel such a great success. The team has always done a great job. So congratulations once again. And yes, the office, I hope, remains as spanking as ever.
Oh, yes, it is. We are learning to use the video walls and the other assets better. Let me just get to the news of the day. We can't dismiss what's just happened. A policy that many in the market have seen as more hawkish than they were prepared for. We saw the OIS yields also rising rather sharply. Your own takeaways?
Well, I think your headlines captured it quite well. While there is a 25 basis point hike, there is a bit of a hawkish stance in the policy statement. And I could not hear most of the press conference, but what I'm hearing from the my people is that the stance remains a bit hawkish. RBI is very clear they need to get inflation under control, and they will continue to do things to ensure that it is brought in the 4 to 4.5% range, which hints at another hike, which hints that the accommodative stance will continue to be withdrawn. While RBI did assure everyone that they will infuse the liquidity if necessary, I think the stance is that we need to get inflation under control, and that also very clearly implies maybe another hike of 25 basis points before things stabilize. While we have gone through close to 225 basis point hike in the last 6 months or so, the hope, while the inflation is coming down, RBI has also very clearly tempered the growth expectations on the GDP side. Yes. So it's a balancing act. They've done a great job till now. Well, obviously, one is hoping that they'll continue to do that as they move forward. It's a very fine balance they're trying to strike. But yes, the stance was more hawkish than people expected.
Okay. Well, actually, banks have had some advantage in this rate hiking cycle. As the governor pointed out, and I'm quoting his numbers, although they have hiked interest rates by about nearly 200 basis points, repo rate, as of yesterday, going from 4 to 5.9, they point out that on outstanding loans, the interest rate has gone up by only 63 basis points. And on deposits, the increase is only 46 basis points. And clearly, all of you banks have shown a higher margin. Will that advantage continue? I mean, at least for this and next quarter.
I think you will see a tempering of the advantage that the banks have got in the next couple of quarters, because on one side, the interest rates have been hiked and we have got the benefit of it. But on the other side, the deposit rates are slowly catching up. If you look at the wholesale deposits, the rates have already gone up by close to 300 basis points. But on the term deposit rates, the hikes have been lower. But as they get repriced with all these hikes on the repo rate side by the RBI, I think the cost of funds will keep going up, and it will not be that easy to continue to pass on this increase in cost of deposits on the lending side. So my view is that NIMs could come under pressure in the next couple of quarters for the industry. I think most of the industry players are clearly hinting at that also. The real issue is not the next couple of quarters. The real issue is how will the next year play out when on one side, the government and RBI would like to continue to push growth rates and like credit to growth to continue. On the other side, there is obviously a squeeze on the liquidity and the deposit growth rates are not coming through. So kind of how the two will play out is the real thing to ponder about and plan for.
Okay. No, I agree with you. That's why I wanted your views on how credit offtake may pan out. The obvious idea of higher rates is to smother aggregate demand somewhat, or moderate it. The system is growing at a steaming 17.2% loan growth, and yours is even faster. Do you think it will slow a bit?
Well, the corporate credit growth continues to remain strong, and the retail and SME side has been strong for a couple of quarters anyway. Partly it is to do with the, I would say, base effect. Partly because of some of the other sectors, other ways the corporates had used to raise money, like the foreign markets or the corporate bond market, are no longer available to the extent they were available earlier. So they are obviously coming back to the banking market. So there are these two factors which should be taken into account. But yes, the growth continues to remain strong. We are seeing that growth becoming more broad-based than before on the corporate side, and the demand conditions continue to improve internally. So my view is the macro conditions are in place for private capex to revive. Yes, the interest rate hikes do change the overall the business case itself for people investing in large private capex. But I think the impact of this interest rate hike is not going to be substantial. So corporates will hopefully continue with some of the capex which they have planned. Government policies around PLI scheme, national infrastructure pipeline, China plus one strategy, Europe plus one strategy, whatever that might be, continues to feed into the India story. So my view is that the credit growth, at least for the next couple of quarters, would remain steady and strong. It just needs to be supported with a better deposit growth story. If it does not play out, then at some stage the banks would be forced to reduce the overall growth rate on their lending side, and that could hurt demand, or it could lead to rise in the pricing which is available for the corporates to raise money at. Because if I have less money to get, I will price it right. I will not give it at any price. I will give it at the right price.
Okay. Can you update us on the Citi deal now that we have you with us, Amitabh? Do you think that you're getting that number of customers that you thought you would get? Will there be any renegotiation of price at all, you think?
Well, the integration for consumer business is underway as per plan across key business, people, technology and operations work streams. A joint steering committee is overseeing the progress, has been since we signed the deal. Customer consult is currently underway, and we understand it has received extremely good traction with strong and positive customer response. We will follow the approach of equivalent or better product proposition to protect customer interest. Based on whatever customer consent we are seeing, based on the business metrics which we have seen, we do not expect any change in price whatsoever, even though the structure of the deal which we have signed with them allowed a change in price if certain business parameters are not met. But I'm just happy to say that the business parameters are generally tracking very, very well. So is the customer consent. So broadly, we are on track with the deal. There are obviously a lot of small things to be done to get to the finish line. And obviously, the teams are working very hard to ensure that we get there.
Okay. And then there was, of course, the other deal, the Max issue. Did you contest the penalty that IRDAI imposed or speak to them? Is there any comeback on that, or is it paid and settled?
Well, we have been in constant touch with the regulator through the entire journey, from the day we started negotiating the deal to when we signed the documents. And obviously now that this order the regulator has passed, we remain committed to our long-term association with Max Life as the promoter and partner. We remain focused on increasing our stake to 19.99. As mentioned earlier, our balanced 7% stake would be subject to regulatory approvals, and we are in regular discussions with the regulators concerned and confident of closing the remaining stake acquisition within the timelines we've envisaged. There might be some change here and there, but we remain very committed, and we will continue to work with the regulators to reach the right solution.
Okay. IRDAI had written to SEBI, right? No word from SEBI to you was there?
The regulator, as part of its process, the regulatory process, does write to the regulators concerned and inform them of some action they have taken. So as part of that action, they are in touch with, I'm sure, the other regulators. The regulators are normally in touch with us on all kinds of inquiries all the time. So I don't want to confirm or deny this everything, but I'm just saying that regulators do keep us asking us questions on very specific matters, but generally things are headed in the right direction.
Okay. Well, just to come back to business, the business part of the Max deal. Now that, Max Financial has also bought the Mitsui stake, are you sensing that there can be some strategic moves afoot? Or do you see your relation with Max Financial altering or evolving in any way?
So this approval, I think, is a very good sign from the regulator that the reason why some of these regulatory concerns emerged was because this application from Mitsui was made, which was part of the original transaction structure itself. They have approved this after the order, they have approved this particular part of the transactions. It's a step forward. And we have a series of things which we had planned as part of that agreement. Our ultimate intention is that the Max Life should get listed, which is where our investment is. And it is part of that process. So no, I do not expect any change in terms of our view or our status in Max Financial Services. As I said, we remain very committed to the company. We like what they're doing. They have done a great job, and we expect that insurance opportunity is large enough for them to continue to, become a bigger player and obviously create more value for its shareholders over a period of time.
Okay, well, let me end with another macro question. You've seen several cycles of the banking sector. Now the banking sector is on a crest. Last time around, it bottomed out perhaps around the millennium 2000 when the bad loans peaked off. And then you had a clear 1 decade excellent run for the banking sector. Where do you think you are now? Do you expect another decade, another 5-6 years of good performance for the banking sector?
Well, the banking sector, as you rightly pointed out, especially the large private sector banks, have strong capital levels, high provision coverage ratios, strong return ratios, and so they seem to be very well placed. The banks have not underwritten risky assets for the last 2 years, partly driven by COVID. RBI is now the CRIL database provides information on any entity on a real-time basis. So information availability and early warning system for the sector is at a whole new level. I talked about the challenges on the deposit side and not on asset quality. Having said that, we will witness recoveries and upgrades normalize with some uptick in specific asset classes if interest rates continue to rise. So there are some asset classes which could get impacted. Nothing alarming at this point in time, but please understand that banks are, obviously banking the lower risk set of customers. The higher set of risk customers could struggle a little bit as interest rates continue to rise, or if the GDP growth slows down. The good times, I do believe, can last for a while, and India is uniquely placed from a geopolitical and situation and all the benefit India could potentially get because of the government policies and how RBI has managed this crisis. But global risks, I would say global risks remain difficult to gauge. Also, let's not underestimate the fact that we are running a fiscal deficit situation. We do need to get that back on track. We need to get inflation on track. Currency has depreciated. So there are some factors at play which need to be washed out for. But overall, India is very well placed, and I would expect there's good times to continue for some time.
Okay, now that's an extremely balanced reply and giving us the many-sided perspective that a banker should be aware of. Thank you very much, Amitabh Chaudhry, for joining us on our big day and for giving us the big picture on banking as well.
It's always a pleasure. Thank you so much. And again, congratulations to CNBC.
Thank you.
Okay.
Thank you so much. So Sonal, you have it there. Definitely banking is on a crest, but as the big man points out, they are very, very aware of what the global slowdown and a fiscal tightness that is imminent will mean for the banks. So anyway, good times ahead. That's the big takeaway.
Oh yes, and we can do with that takeaway, right? Lata, thank you so much for taking us through that interesting conversation. That's the word coming in from Axis Bank. The stock also